Good morning, everyone, and thank you very much for joining me. This is the morning market review. It is Tuesday and it is the 3rd of October. My name is Russell Shaw. I'm a senior market specialist at FXCM. Just want to draw your attention to my email address, which is rshaw@fxcm.com. And if you would like to correspond, that is the email address to use. I'm going to go ahead and bring up the disclaimers. We're going to start off with our high risk investment warning, and I'll keep this on screen for a few moments for you to have a read through. Good morning, Howard. Nice to have you on the webinar as always. Good morning, Kim, James, and Richard. Good morning, Raj. All right, let us bring up the market commentaries disclaimer. Good morning, Matthijs. Nice to have you on the webinar. All right, and our references, MarketScope 2.0 and TradingView.com. All right, so let's start with our real yield again. I think that this is the key driver in the market. We've looked at it yesterday. What did we look at? We looked at this overbought condition. Now, it's tricky because Lorraine Mester, the president of the Cleveland Fed, talked up rates again yesterday, and the question we dealing with and that we're trying to unpack is how much longer can we how much higher can the real interest rate go? It can go higher, but I would think that it would have to pull back, and that would set up the platform for some sort of movement higher. The question, of course, well, when do we start seeing the normalization of the rate? And that is that's the big puzzle. That's the big puzzle. The idea here is, of course, that it's trending up, but I think there's too much froth on that. And if the real rate starts pulling back, then the ripple effect goes through to the financial instruments. Let's just take a look at the correlation between the real rate and the dollar. Hello, Desai. Good morning to you. Nice to have you on the webinar. All right, so let's take out the RSI for a moment. Take a look at this. Let's take out the RSI. And let's go ahead and put in the US dollar underneath this, okay? All right, now what we're going to do is we're going to add in another indicator, and the indicator we're going to put in is called the correlation coefficient. So we'll bring that in. Correlation coefficient. And to make sure that's the US dollar. And just take a look at this. I'll explain to you what we're seeing in the correlation coefficient. It says 97.97, so there's a 97% positive correlation between the real rate and the US dollar. Now, let me just explain that, what the correlation coefficient is telling us. We're just going to bring Microsoft Paint up. And when you look at a correlation coefficient, there's three areas that you're looking at. Okay, you look sort of at three levels. And the level would be 1, which is 100%, right? It would be -1, which would be minus 100%. And in the middle, you've got 0. Now, what tends to happen if you've got instruments that are correlated at 1 or 100%? We're looking at two instruments. Okay, they're going to be moving together, sort of in terms of being really just moving the same direction, the same amplitude, and that's what a positive correlation is. The -1 is basically they're moving together but in opposite directions. Okay, so there is a correlation, but they're moving in opposite directions. They're effectively canceling each other out. And then, of course, you've got naught where there's no correlation. In other words, one could move up, and the other one could move like this. I mean, there's no correlation. But the closer we get to 1, the more aligned the two are in terms of being in step with one another. Well, again, what's our correlation here? It's 0.97. It's extremely robust. It's extremely high. In other words, the dollar is moving very much in line with what the real rate is doing, okay, at this particular time. Even if we go up to a weekly time frame, it's an extremely strong correlation. It's 85%. So what are we suggesting here? We're suggesting that, number one, the real rate to me looks quite frothy. I'm not sure how much higher it can go without some sort of release. Okay, it's at 2.35%. Now, if there's going to be some sort of release, it's going to move to the downside. And if the correlation is at 97%, you would expect the dollar to follow down. Now, this puts us into a very uncomfortable position because, well, Richard's asking, what are some of our trades? It really depends on your trading plan. Does your trading plan make provision for counter trend trades, or are you waiting to trade with the trend? Now, let's just go back to Microsoft Paint, okay? And what we can do here is, well, we know that trends move in terms of zigs and zags, ebbs and flows, okay? That's an uptrend. I think we can also see that this is a downtrend, okay? And what's the key? Well, in an uptrend, you have higher trough followed by higher peaks, and in a downtrend, you have lower peaks followed by lower troughs. The question is, which side are you trading on? Okay, and this can only be answered by your trading plan. Are you taking the impulse moves up in an uptrend, and are you taking the impulse moves down in a downtrend? Or does your trading plan make provision for trading the counters? In other words, the frothy overbought. Now, generally speaking, what we try and do on the webinar is we actually try and trade with the trend. So we try and wait for these pullbacks. So if we're trying to wait for these pullbacks, it puts us in a very uncomfortable position because we're kind of waiting for a pullback here. And if we're waiting for a pullback, then we can get into the next impulse move up. So the idea here is we're looking very frothy on that real rate. And the question again I pose is, well, how much higher can the real rate go? I would expect some sort of pullback, especially after the almost release in the core PCE numbers that we saw on Friday. Is just there's there is a theme running through the market: higher for longer, higher for longer. Well, the higher the US 10-year real yield stays at the moment, the more it's going to pull back like an elastic when it does correct. So just be aware of that we do seem to be at some sort of apex in terms of the impulse moves. Okay, that's where we find ourselves at the moment. What we can do is, let's just take a look at the real rate versus the Nasdaq 100. Let's just put in your NAS 100. And let's just see what kind of correlation there is with the tech index. Okay, so now let's just change the correlation coefficient and put in NAS 100 here. And you can see we've got a very strong inverse relationship. We've got it at 84%. In other words, if there's going to be some sort of pullback in the real rate, we expect some sort of rally in the Nasdaq. It moves in a opposite direction. So could the pullback be in fact a trend reversal? Kim asks, which is of course a very good question. Now, I think there's two ways to look at this, Kim. The first way is on a fundamental basis. So the dot plot so the previous Fed meeting came out with a new dot plot, and that new dot plot pushed out the rate cuts. Rate cuts were pushed out further into 2024, but it does seem as if the Fed is making provisions for rate cuts. Okay, so and I think markets are forward looking, and I think that eventually markets are going to have to discount those rate cuts. But the question is, of course, when? The timing is always going to be difficult, isn't it? Well, the second way that we can look at it is with a trend, okay? And unfortunately, with a trend, you're not going to call the top and you're not going to call the bottom because you need 4 points to call a trend reversal. You need a peak, you need a trough, okay? You need a lower peak, and you would need a lower trough. Okay, so again, prediction to me seems something we want to be very careful with. If we got a setup like this, Kim, if we got something like this, then we can start talking about a trend reversal, because then we've got the 4 points, don't we? So the answer to your question is yes, it can. But remember, we've got very influential people like Loretta Mester talking up interest rates. We don't want to fight the Fed. Okay, so at the moment, the trend is up. At the moment, the trend is up, subject to correction. And how do we know the trend is up? Well, higher troughs followed by higher peaks, and it just seems that we are frothy in an uptrend. So I don't see the trend reversing just yet, but I don't want to predict. I want to react. So at the moment, any sort of dip here would be, well, it's probably a dip in the uptrend for the yield. It's probably a dip in the uptrend for the US dollar. It's probably a rally in a downtrend for the risk side of the markets. Now, what we can do is we can take a look at, say, the DAX. This is, again, very interesting chart. If you take a look at it on a weekly basis, it's got the downtrend set in. It's got the lower peak, followed by the lower trough. We're below the 30-week moving average, and that 30-week moving average is rolling over. How would we view this chart with some sort of positivity? Well, we would have to wait What would we need to wait for? We'd need to wait for the candlestick to get above the trend line. That to me would suggest that the downtrend is waning. So that's the first thing. The second thing is we would need to see the RSI move above 50. Okay, at the moment we don't have either of those. So it looks as if DAX is certainly feeling the pressure of these higher yields. But if there is a pullback in the yields, there's probably going to be a pullback in the risk markets as well. Probably some sort of movement upside. That makes it difficult. Oh, does our trading plan make provisions for counter trend trading, or are we waiting for the correction and then getting into the next impulse move? Okay, the fact of the matter is we've got a downward looking trend on DAX. If you go and take a look at NASDAQ, let's just bring up NASDAQ. Okay, here is the NASDAQ. We do have again a lower peak followed by a lower trough, and we need to see a break above this trend line to see the downtrend starting to wane. There does seem to be some evidence of resilience in NASDAQ 100. Can you see that the RSI is popping above 50? That potentially means that we're seeing the dips in the trends or the pullbacks in the trends. Okay, so we see DAX looks a lot more malignant than NASDAQ 100. NASDAQ 100 seems to be suggesting a rally in the downtrend. Okay, if there's going to be a rally in the downtrend, I would expect real rate to pull back. That just makes sense. They seem to be the key driver. It seems to be the key driver there. Let's take a look at S&P 500. Okay, again, not the prettiest chart. Lower peak, lower trough. That is the definition of a downtrend. Where are we with the RSI? It's below 50. If NASDAQ leads up, then perhaps we get a bounce in the S&P as well. It's not looking too pretty as we start the fourth quarter. Again, we're in a tough position here. And I would suggest that we rather look at reacting than predicting, because it's impossible to predict. Okay, what we can do is we can try and use our overbought condition to suggest what we think is going to happen, and then act on the technical signals as they manifest. So I don't like the DAX, I don't like the S&P, even the NASDAQ's looking like it's under pressure, but it just seems as if we've got this froth that needs to dissipate. Let's take a look at gold. Gold is typically it moves in the opposite direction to the US dollar. Let's bring that, and you can see how even gold is really getting lambasted at the moment. It's really capitulating. Lower peak over here. Here is that lower trough. Gold tends to move in an opposite direction to the US dollar, and it's really just been hammered over the last week and a bit. Now, again, if we get the real rate over here pulling back, if we get the real rate pulling back, I would expect to see these counter trend movements. Okay, now this is the question you ask yourselves: does my trading plan, because everyone must have a trading plan that's tested, does my trading plan make provision for counter trends, or do we wait for the proverbial dips or the rallies in the trends? Raj asking a brilliant question: does oil have an influence also? Yeah, absolutely. I would expect that oil, okay, is putting a pressure on inflation. It's coming through with inflationary pressures. That's probably pushing real rates up. That's probably, so if we see some sort of moderation in the oil price actually has been showing some signs of moderation just over the last few trading sessions. Let's just take a look. Okay, so you can see that it's pulling back here. We're now right at about 90, but we've got this uptrend. We've got this uptrend. So some sort of higher trough here, potentially. So oil certainly, definitely making an impact. Now, what's generally my thinking going to happen with oil is that there are sort of supply forces leading into demand forces. Supply, well, we're seeing that contraction in supply. That's leading the price of oil up. That seems to be impacting on demand. That's pulling demand down, and that's probably what we're seeing here as the demand and supply forces trying to sort of balance out with one another. But by and large, the trend is up, and the primary driver of oil price, one would think, would be the supply constraints, and that inflationary pressures, I think, really a concern for central bankers. Like, yes, they can control the core side of inflation, but they do want to see the headline number come down to that 2%. So that's where we are at the moment. All right, are there any other questions there? At the moment, we've just got to see if this froth normalizes. The more it sort of maintains, I think the more the pullback's going to catapult. The question is, when do we see the pullback? All right, guys, let's wrap up here. Tomorrow we'll have 2 webinars. We'll have the Crypto Minute as well. Thank you very much for joining me this morning, and I wish you all a good day and evening ahead. Thanks, guys.